And then he actually started investing in multiple ventures through his fund. So he through his family fund. So after that, I think recently, he started a real estate growth fund where um, he wants to provide the opportunity to multiple people to participate in real estate. So with that introduction, um, before we get into the fund aspect, Shekhar, if you could actually tell me, um, when we were having this discussion, see, until 1 year ago, the Shekhar that I knew is a technocrat. So completely involved in technology and completely involved in IT. So all of a sudden, I see a sudden shift in your not sudden shift, rather say another uh, weapon in your repertoire. So which is real estate. So what attracted you to real estate?
Yeah, first of all, thank you, Venkat, and good morning and good evening, everyone. Because I know it looks like a bunch of them are joining from India as well. For sure, I know Satish Ketaneri, which I know he's in India. So thanks everyone for joining. And I'm glad you mentioned that word about intentional entrepreneurship. Um, I believe in doing anything with a proper intention and purpose behind it. Even with the real estate, it is the same thing. As Venkat mentioned, if I look back probably 8-9 months ago or a year ago, I was not anything related to the real estate. I was primarily heads down focused on the businesses, on venture capital, private equity, on the tech and investments. I have built a portfolio of my own family office of many companies, and also invested in pretty large private equity platforms and whatnot. So the reason is that I like the challenges, and I like the challenge of growing the companies, building the companies. That was what attracted me. And as a good old American citizen, I accepted the fact that paying the taxes is your duty as a citizen, that you have to continue to do that. But at some point, it dawned on me that there must be a better way to do it. And that was the first kind of trigger point for me to look at saying, what is it? And the second thing that also kind of stirred my interest into this side of it was looking at saying, I would consider myself as fortunate to have found the little success that I had in my own entrepreneurial journey. And I know, having seen my success, and also having seen many startup founders over the last 7-8 years, I know how hard it is. And despite all the efforts and the time and money and efforts that you put into a startup, there is still a huge factor of luck that has to work with you for you to make that success. And when you're talking about success, I'm not talking about incremental success. I'm talking about generational wealth type of success. And when you double down on that and look at it, say, okay, what is it? People who don't have the fortune of being able to build a company and create super smart technology-wise, super lucky in building that. How do they do it? How do others do it? And when you look at the most of the rich people traditionally in India or anywhere in the world for that matter, real estate is one of the biggest asset class that kind of contributes to that wealth class, right? And how do people do that? Again, I'm not sitting here to say that I have all the answers, but at least I started looking into that and saying, how do we do that? Yeah, right. Before I jump in, I know Om, you have raised your hand there. I wanted to make sure that if there's something that I'm.
No. That was for who is into real estate. I think
Okay, got it.
Yeah.
Okay, yeah. And I know Mukesh, who's partnering with, is also on the call here. Mukesh, get on the video if you can, and I'll introduce you in a minute. So coming back to this, so for me, the two key things is, one is, how do we do efficiently tax-wise? If you are on the fortunate side of making money and being on the other side of it, what is it that you need to do to plan efficiently on the tax side of it? And the left-hand side of it is like, if I'm not built a company and I haven't seen that kind of success, how do I build? How do I put together my plan in that one? And the next hurdle I saw is that, money makes money, right? So if you want to get into the real estate and get started, most of the time we see that the hurdle to get in is pretty high, right? I mean, for me, it was very evident is that most of the folks who I spoke to, a lot of them have started their own real estate ventures and whatnot, and they've been doing it quite successfully. But for them, the bar is pretty high. Like, I mean, you might be putting $1 million, $2 million, $5 million to get started on that one. And I said, that's not necessarily the answer for a day-to-day folks who are doing regular job and trying to very happy with that, but they want to also have an alternate source of income. That kind of journey led me into this path and in discovering this and say that, okay, we need to do, first of all, show the avenues of how you can do tax efficient planning. Second, use real estate as a means to generate generational wealth. And the last but not least, give an entry point where even if you are someone who has just started your job, because the motivation for me, quite honestly, is that my daughter just started a job last year. And the first thing when the beginning of the year, she said, like, nobody told me in school that I have to pay taxes on the money. I thought it was all my money. Why do I need to give this money tax, right? So that is saying like, okay, how do we help the younger generation not make the same mistakes as we have done, because nobody told us, held our hands when we came into the US 20, 30 years ago, right? So all of that kind of led me into starting this thing. Again, selfishly, I started it for my own thing. And then I said, I need to spread this thing. I need to be able to democratize this information and this knowledge. Whether people want to join and come along with us or they do it by themselves, it doesn't matter to me, because the objective is for everybody to have this knowledge and information to be able to leverage for them, right? I mean, I could do it by myself, but I wanted to bring along everyone in this journey. So with that, I'm going to introduce Mukesh, who's probably a lot of you who are in the real estate side know Mukesh. And when I started jumping into this thing, and with all my research and everything, reached out to Mukesh and they're like, Mukesh, I want to partner with you because I've worked with Mukesh many years and know him personally. And I wanted to have someone credible who has that knowledge as well as the integrity and the credibility to partner with, because I don't like putting out my name, and so is Mukesh, unless we know that we are going to work together. So Mukesh, I'll let you introduce, and then maybe Venkat, if we don't have any further question, we can jump into what is it. I talked about the why we started this, and then we can jump into what we are actually doing behind the why.
Sure. So before we jump into the opportunity, Sekhar, one more question. ఇండియాలో టిపికల్ గా చూసుకుంటే గనక చాలా మంది రియల్ ఎస్టేట్ అనగానే ఫస్ట్ ఆలోచించేది ల్యాండ్. ఎందుకంటే మనకి the participant has set the caption language to English. Okay. It's a reminder that to speak in English. Okay, thank you. So going back, I think the first thing that anyone, actually all of us, think of when we hear real estate is land. So you simply buy a piece of land and sit on it for 1 year, maybe 2 years, maybe 3 years, and then you flip. You make maybe 3 times, maybe you make a double, or you may even make 10 times.
Right.
Typically this happened in the suburbs of Hyderabad, suburbs of Visakhapatnam, any of the big cities. Now that uh, uh, madness also um, reached Austin.
Right.
So Austin also saw a similar growth, exponential growth in the last 5 years. Now, um, what is your style? Are you, when you say generational wealth, when you say growth fund, retail growth fund, triple net, how is it different from owning land?
Yeah, I'll give you a little bit of my context, and then I want Mukesh to answer that and introduce himself, because he has a lot more depth and knowledge in this one. So Venkat, great question. there is nothing wrong in picking a different asset class within the real estate, right? Whether you talk about land, you talk about multifamily apartment condos, or you talk about office buildings, each one of them has its own ups and downs and its own cycles in which they go through. The reason why we kind of honed in into this particular one is going back to my why, right? My why is, first thing is, I want to make sure that we're giving this opportunity for everyone to participate, which means that the bar has to be lower, the entry level has to be lower, right? If I'm looking at a land, I might have to put in a big amount of capital. If you as an individual are doing, that's one thing. Second thing is, I wanted to have at least this particular fund, the purpose of this one is to have recurring income coming on a periodic basis, on a quarterly basis, and we'll get into those details, that there has to be income, because land is binary, right? You buy it, you hold it for X amount of years, and you sell it and you get the money. Whereas this one, you're getting incremental revenue income every month or every quarter, depending upon how it is set up. So so one is lower bar of entry for everybody to come and join. And the second thing is to have income coming in periodically versus waiting on that, right? That is the sole purpose of this particular fund. And Mukesh, you can talk more about the real estate and introduce yourself in terms of the asset classes. I know we have something on we'll share that also.
Sure. Yeah. Thanks, Venkat. Appreciate you bringing us on board. And your question actually is very relevant to the topic today, right? That we want to discuss is building wealth, right? Through via real estate. So there are a couple of things. I'll just tell a little bit of myself and why, and that ties into actually your question of land. When I started my journey in real estate back in 2008, it was double recession. And I started buying some townhomes and single family homes to tap my, get my feet wet, understand the process, understand the legality. There was just a lot of things to learn. And at that time, the small investment amount that I had was through my savings of my job. So I said, hey, why don't I dab into it and learn whatever I can and buy whatever I can with my small amount of money, right? And this was back in Northwest, so where there is no demand for land over there. The population is highly light, and so there is no such thing called land investment over there, and it would not grow. So I started buying rental properties and did that, and I built first year was lot of learnings and scary actually, right? Because of the laws, you're new in the country, you just got your citizenship, and you're trying to get into the legal aspects of tenancy, renting, property management, contracts, buying, purchase, sale, negotiations, and things like that. So first year, try to get your handle on it. And then I built a decent portfolio, and I was operating around 42 such or something invoices on a monthly basis, right? So that's when I realized, this was 2013 or something. This when I realized, man, something's not right. I don't think someone has become rich doing what I'm doing. Because it was just extreme amount of effort, and I still had my IT job at that time, right? So that's when I realized, oh, okay, maybe I'm doing too many things, but I'm doing small things, right? So I sold my entire portfolio at that time, and then I got into buying lands, right? And of course, buying land at that time had two options. One was the complex land of development, and then agriculture land. So I thought, hey, let me learn the basics, and that's what I've done in my life. I always learn the basics, always put my own money first. Fail wherever I can, fail soon, and try all it out. And then once I get confident about it, I know the game, then I step it up to the next level. So I bought some agriculture lands over here to answer your question, Venkat. And these were all cheap lands at that time. Back in 2014, when I moved into Texas, I'm talking about $2,000 an acre, $3,000 an acre land, right? Which is unheard of right now. So we bought decent. We bought around 1,000+ acres of land. Myself, not just myself, but myself and my close family members and friends. We sat on it for a couple of years, and it was appreciating, but I never sold it. So that's when I realized, oops, man, my money is locked into the land. I'm not making a penny out of it, right? Yes, it is appreciating on paper, and who knows the day I sell what it will be, whether it will be up, down, we don't know that. So that's when I realized it's a good asset to diversify, but it's not a great asset to generate cash flow and grow, right? Because you want money to be generating and redeploying and growing, right? So that's when I went into development side of the aspects of. Then we bought some development lands, knowing some basics about the land in the first 2 to 3 years, 2014 to 10. I started my first development project. Bought my land to develop, and I started that in Carrollton. People who are local to Texas might know that. And then I did my first development project, and I multiplied. I multiplied my equity 6 times. That's when I realized, oh man, I don't have to wait for the land to appreciate. I can force multiplication of my equity by adding value to the land. But I also realized the effort, right? Venkat, we have gone through this couple of times, and we have gone through a couple of development projects together. It's a tough cycle. It's not an easy cycle, and it's a one-way cycle. You can't stop in between. The amount of equity you need and the amount of debt you have to raise and you have to take burden on is humongous. It's not a small asset like this, and there is no cash flow to that asset when you're in construction. So typically the lenders will ask, hey, high equity, full recourse loan, and they will want to see your experience of doing it. You won't get a development loan just because you want to go and do one, right? And now in the current environment, it's absolutely unheard of, right? The percentage of loans you used to get back in the good economy from 2014 to 2022 was still higher. Right now, after 2022, lenders have become extremely, extremely cautious, and that has become even tougher, right? So now you're taking a bigger risk, you're putting more equity, and the risk is more. There are a lot of headwinds than tailwinds right now. So that's when we shifted our gears and we said, hey, maybe there is a better tool here to generate cash flow, get easier debt, and scale up, and also not take the risk of 5 years of not development. That's when we got into this buying commercial properties into a depth. We have bought some commercial properties, me and Sekhar, myself, back in 2020, 2021. I myself have invested in 7-Eleven, Montessori schools, Dollar General, Dollar stores, and myself. And that was back then, and it was at 5.75% cap rate, right? It was decent because the interest rate was 4%, right? I think, Shekhar, our first loan was what, 3.7 some interest rate, right? And we said, yeah, okay, makes sense, 1.5% spread, not bad, and we enjoyed it. Then we sold it for a decent appreciation. But now what I'm seeing, based on the research and everything that we follow, because of the fund we have, we follow all asset classes. We have almost done almost all asset classes other than hospitality and industrial. We have done single family, multifamily, apartments, commercial, Montessori schools, office, retail. So when we were tracking all this asset class and very closely in the last 2 years, because of the high interest rate, the class that got distressed the most, as everyone might have heard, is the commercial real estate. It's called CRE also. So there was a huge distress. When I say distress, I mean the price got condensed over there, right? Good same assets, good same lease, good same tenants. All I had to do was filter out the bad ones, right? And more good ones were available than bad ones. When I bought it back in 2018, 2019, more bad ones were available and less good ones were available because the price was so cutthroat. Interest rate was low. Everyone was bidding on it with a high price. And we had to back out because we were conservative, and I had to back out saying that, man, I don't want to be so aggressive in buying pricing. Reasons being simple. When the rate goes up, you're stuck, right? And that's when probably many people got stuck. When the rate went up with their aggressive pricing, they went in. And now what's happening? People are selling, right? So that's what happened now. We are getting the same good properties, and we are identifying the same strong tenants, corporate backed leases. That means leases that are not just backed by the local store guy over there, but also by the corporate. So if they do decide to close one of the stores of the chain, the corporate will still be responsible for paying us the rent. Triple net properties, where all the property taxes, everyone in Texas knows how the property taxes and insurance have gone up, right? All the increase in property taxes, all the increase in insurance and repairs and maintenance are all the responsibility of the tenant. So we said, hey, you know what? These are the properties we want to go against, right? We want long-term leases. We want leases, if possible, with annual rent increases, which is extremely hard to find, with triple net leases, corporate guarantee, and in great location. A location where I won't have problem giving that space to somebody else, right? There is enough demand, there is enough strong demographic, and other tenant might jump in. So that's when, Venkat, we got into this. And when we realized the cap rate have gone from 5.75% to 7% cap rate in this segment. So that's when me and Shekhar came together, and we both had the same thought process. Coincidentally, it's coincided, and timing is everything, right? And right now, the timing is there for us to buy these assets, and we are buying the same assets now at 7% cap rate, which is unheard of. Historically, it's almost 22% discounted. And I'll show you the graph that tracks all the commercial real estate data that shows where commercial real estate was at the peak, high right now, where it is at the lowest, and there is a difference of around 22% discounted overall. And now how the graph is turning back up again, because there is a lot of talk of interest rate drop again. So a lot of people are jumping in and the prices are tickling up. So we have a small amount of window to buy this asset class, and that's the reason, Venkat. Hopefully that, I know I gave you a long-winded answer, but I just wanted to make sure that was the core intent of the webinar today, which you hit with that question. And that's the journey fading away from land.
Yeah, perfect. So
Yes.
we have some questions here. So before you actually, or maybe you can start with the presentation, maybe for 15-20 minutes, and then we have lots of questions.
Right.
And then if you get a chance, please answer them during your presentation. Number one, what is the difference between investing in US real estate versus India real estate? So that's one question that you can answer maybe during the presentation.
Sure.
The second one is,
I mean,
what are the
yeah.
opportunities in Dubai? I think this is the second. I think these are the two questions you can answer, but you can get started with the presentation, Mukesh, Shekhar, and then we can 15-20 minutes, and then we'll take the Q&A. There's lots of interest in the topic.
Maybe to start off with, right, I think to be clear, what we are focusing on is the US part of the real estate, very specifically, for one thing, as an entrepreneur, one thing I learned is that the opportunity and the scale that you have is massive, but a lot of time that's a disadvantage when you open your lens and you focus on everything, you miss the actual board. So I learned that whatever it is, you got to zoom in and you need to focus into what it is, right? So in this case, yes, real estate is a vast ocean, and it is definitely a means to generate wealth. In every specific asset class, you can generate wealth in real estate, and there are nuances of how you do it in India, how you do it in Dubai, how you do it in US. There's differences, obviously, many things, including the tax codes, the interest rates, the property rights. There's so many of them. I'm not an expert. I'm not going to go into all of that. What we are focusing on is what is in US within this specific asset class. And it goes back to, it is important for
it's 11 o'clock.
It's important for everyone to understand the why, right? The why here is that we want to be able to give at the entry level folks who want to get into real estate, who are not necessarily sitting on loads of cash, that they can do it on their own, right? Obviously, if you have that, more power to you, you can do it. But this is for the rest of the probably 99% of the folks who don't necessarily have that opportunity. How do I get involved? How do I get started into the real estate? And how do I do it with minimal risk, right? Because you need to generate income, but at the same time, build the generational wealth. So that is the why. And let me and Mukesh quickly walk through the what we are doing to support that why, and then we can open it up for Q&A. So let me just quickly flip through a couple of slides, and I'll pause on a lot of this we already covered. Mukesh, I know you like to get the disclaimer part of
Yeah,
it.
yeah. Like this is a fund, right? So we definitely like to get the disclaimer out. So guys, please take the moment to read the disclosure. We are not financial advisors. We are not attorneys. So please take your own advice from them. When it comes to any investment, real estate is also not a guaranteed return. Neither is it a safe investment. Like any investment, it's just an investment. It comes with its own risk. It comes with its own reward, right? We are going to focus on US real estate investment today. I especially focused on commercial real estate, cash flowing assets, strong growing demographic areas, and that's what we are going to focus on today. So.
Yeah, cool. So with that, right? So I think Mukesh kind of talked about his journey already, about the different things that he has done it. So for the purpose of keeping moving, I'm not going to go into detail. You already heard about Mukesh's background, and you heard about my background. Again, this is more for people who don't know us, and we'll share this slide deck. It's already, I think, in the chat. I think you can look at it just to provide some background. So again, the overview, and this is also something we touched upon, right? What is the fund and why are we doing it? This is number one, to generate tax positive cash flows, right? So every asset we are investing in has, from day one, has a rent and a long-term rent, and we'll show that in detail how it is doing. The next 2 points are important when we are talking about generational wealth. And this is where this is more especially applicable for the US and the retail in this space as well. And for folks who are in the US and who have some exposure to the real estate, they probably know it. So what I'll give you an example and walk through that one. Let's say if you have invested $100,000 in this particular portfolio of real estate, and you're getting, let's say, $5,000 or $6,000 in rent after all the costs and everything. Let's say you're getting that $5,000 as a rent. So in any other class, in any other income, if you get that 5,000, you have to pay the tax for that 5,000. But in this particular cases, there's something called depreciation, and then there is segregated depreciation, there is accelerated depreciation. We'll get into those things. But essentially, in the $100,000 asset, in year one, let's say you're getting roughly about $50,000 to $60,000 in depreciation. What that means is, even if you take $50,000 as a depreciation, you subtract your $5,000 income you get, which means on paper, you are showing that you have a $45,000 loss, right? So that is an important thing, because not only are you not paying the tax on that $5,000, but the remaining $45,000 is considered as a loss for you on paper, which you can offset against your other income you might have, right? If you have income from your stocks or your other side, you could offset against that. That's why it is an important thing, right? The next part of it is, first step is the depreciation, which you are deferring your taxes for as long as you are holding that asset. The next thing is, let's say 5-6 years down the road, you want to now sell this asset. At that point, there's something called, again, this is in the context of US, what you call as a 1031 exchange. If I buy a property and sell this property for and buying a new property, which is either equal or higher than this one, and if I do something called a 1031 exchange, I again don't pay the tax, right? So you are, as long as you're holding that second property, you're continuing to defer that tax. So think about that. If you look at the Trumps of the world and everyone and the big real estate moguls, essentially that is the biggest loophole or a asset that you have as a real estate holder, is that when you don't pay the tax on a yearly basis because you're taking advantage of the depreciation, and when you sell it, you're taking advantage of the 1031 exchange, and you again don't pay the tax. And if you keep on multiplying that over a period of X number of years, right? Let's say you started at year 20 when you're 20 or 21 year old with the first job, and you do it for 20, 25 years, you are sitting on a pretty large asset, real estate wise, and which is generating income, and you haven't paid the tax, and that tax is multiplying. And the last but not the least is inheritance. And again, I'm not a tax expert, I'm not a CPA, but this is based on all the research and all the due diligence we have done. These are all specific laws that are there as of today. We don't know how they might change next year or next government, and all of those risks are there. But as of what it is in US, every parent can give to the child $13 million as part of their inheritance, right? So that means a wife and husband can give $26 million tax-free as an inheritance to single child. So you take this example of where you build this asset, and at the end of, let's say, when you are 50 or 60, you're saying, okay, I want to give it to my kid. When you give it to them, their tax basis becomes zero. So this $100,000 asset, let's say 20 years down the road, let's say it's $1 million or $2 million. When you give that to your children, they're paying zero tax, and that becomes their cost. They only pay tax on top of that. That is how the essence of what we're trying to do is to be able to do a generational wealth, you need to do efficiently tax planning, and the saving that you're doing from the tax has to multiply and compound over a period of time, so that ideally you're never paying tax on that one, right? You keep on differing, and then you pass it to the next generation and you build that wealth. So that's the purpose of this fund. And now Mukesh mentioned about the real estate and the cycle. Maybe Mukesh, you can talk a minute on this one.
I'll spend a minute here. As I mentioned, if you see the graph, right, each light green graph, and I posted, by the way, everyone who has joined new, I posted the link to the PowerPoint presentation on the chat box. And if you don't have it, just reach out to Sekhar or myself and we will send it to you. So this chart, this company is called Green Street. It's a large company, and they track all commercial transactions across US. And as you see, the light green charts are each quarter since 2008, the double recession. And then the black is the median of the all the chart numbers, right? As you can see over here, this was from June of last month. So this has tracked since 2008, all the quarters. So if you see from the highest peak last time, it was post-COVID, right after post-COVID in 2021, 2022, before the interest rates increased. It has fallen from then since now up to 22%. And then if you go back in history, if you look at 2008 onwards, right, if you see after we came out of the double recession, the index line has gone up consistently, and then back again during pandemic it went down. So if you saw, it ran continuously for almost 10 years, and then in 2019, 2020, it fell down during pandemic. There was everyone knows, right? Commercial retail was hit pretty bad over there with no business, and that carried on for a year and a half. And then the PPP and all the supplements came and saved the people and the jobs. And then commercial real estate went back again. It got caught up into soon after that. And then it had again a long run of continuous price increase, commercial real estate. And then back in 2020, that time with the COVID, it dipped again. And if you see at the very tail end of it, right, you see that line is going back up. You see that if everyone can zoom in, you see the very tail end of the black line. What that is showing is at the bottom, if you see the 3 grand charts, last month, the prices went up. So after all the dip, after all these months and quarters, last 8 quarters, finally, the commercial real estate market is now picking up again on the positive direction. So that's what this graph is telling you. And that's the reason why we said, why now? This is my why now piece of the channel. We are expecting next 1 year rates to either stabilize or decrease. And either way, commercial real estate will go up. And we want to buy them in the fund at a discounted price before it hits the peak again, right? So this is the timing for us. So this one we covered a little bit. I'm just going to talk about a few more points since Venkat, you wanted us to wrap up in 20 minutes. I think the only difference thing that, as I mentioned, 100% occupied properties is what we are buying for. Single tenant, high credit rated tenants, corporate guaranteed leases with triple net lease, with tenant taking all the responsibilities of the expenses. And long-term leases is what we are filtering out as the leases that are more than 10. Our average on the 2 properties is 15 years that we have leases. In addition, we also found properties where there is annual rent increases, which is very rare, but we found it, so we put them in the fund right now. They're in contract. And those are the 2 properties we are presenting today. One other thing I'd like to add, Sekhar, if you can go to the next slide if you want, on the acquisition and the diversification, by buying multiple smaller assets, like we are targeting 4.5 million to 5 million asset worth in the fund, and maybe 5 properties in this one fund of 30 million that we are targeting, is the reason why we want to buy multiple assets, because this will give us various diversification of a location, different tenant, and a different business, right? One is a on the border, right? It's a national chain restaurant, right? It's in California, Texas, many South countries. It's doing well, and it gives you one diversification, right? Other is a quick loop, which is a auto service. Third one we are looking at is a fitness. So this gives you different types of diversification to invest in the business model also. So that's another thing that we look for when we do this, right? And of course, with all those six things of low occupancy, that also generates a less headache, because the model we are going with creates very low management burden on us. So that reduces our property management fee. Whereas me and Sekhar decided to do the property management as part of the asset management. We are not charging anything extra, neither are we hiring a third party for property management, because the overhead we felt was pretty low that can be self-managed. So that keeps all the fund costs extremely low and gives more returns to the investors. Okay. Sekhar already touched upon tax benefits, and Sekhar, you want to talk about the key fund terms?
Yeah, so this is just I'm going to take another 5 minutes to go through this one, and then also an example ROI, and then we can open it up for Q&A. So what is this fund, right? So the fund itself is a 7-year fund. What that means is that whoever the investors who come in, they are locked in for the 7 years for the term of the fund. But there's going to be distributions on the profits and the income rent that we are generating that will be given on a quarterly basis throughout the life of the fund. What we are expecting from an ROI, and I know that was one of the questions in this, is that annualized ROI, 12 to 28%, depending upon different investment classes that you come in. And as I mentioned, it's going to be a quarterly distribution. There's 3 different types of investors that we are, investment classes that we are offering. Class A being if someone comes in at a $500,000 or more, they're going to be getting 18% hurdle, and similarly for Class B, which is $250K, it's 15%, and Class C, it's 12%. For folks who are not used to the terms of hurdle and ROI, ROI is basically return on your investment, what a percentage on that. So if I say, for example, 12% annualized ROI, and if you are holding it for 7 years, that means for $100 you're putting in, you're getting $84, 7 times 12, right? So that's the return. And the hurdle means that if you are coming in at a Class C, which is a $50,000 investment, and your hurdle is 12, and we are holding it for 7 years, that means that at a minimum, you're going to get that $84 for that 7 years, for that $100 of investment. But if you get more than $84, which means that you have crossed that hurdle of 12%, then only the sponsors, which is Mukesh and I, get a higher share of profit, which is 50-50. Anything that we generate above $84 of profit for the $100 you invest, we take 50-50. Until then, we only take 15% of that. So that's what the hurdle means. And as a sponsor, we are investing a minimum of $1 million in this one. It could go more depending upon how all of this ends up, but at least a minimum of it. And then Mukesh talked about the asset management fees and why we are managing it, and we're not taking the asset management fee in this case, because also it's a triple net lease, which helps us. For the rest of the fees, there is an acquisition fees. Whenever there is a property that is acquired, there's a 1% of that is charged. And after that, it's 1% of the rent for the asset management. We're looking at the Dallas area mostly, in the Dallas-Fort Worth area, where we see the industry growth and everything. Again, the same model could be replicated in other areas. We could pick Orlando, we could pick Miami, in other areas where we see. But for this particular fund, again, it's only 5 properties. So that's what we are looking at. Mukesh touched upon a little bit about one of the properties. So just maybe, Mukesh, you want to give a quick highlight of one of this property?
Sure. Yeah. So this is the one of the 2 properties that we have in contract. It's a quick car lube and tube. Many people might have seen, and they take their car for their services, tire change and everything. It's a physical service And then this has a corporate backing lease, and it is complete absolute triple net lease where, as always, property taxes and insurance and repairs and maintenance are all tenant responsibility. This property also had a unique 2% annual rent increase at the minimum, and the max it can go up to 6% annual increase, and then it compounds, right, every year. And then it is capped due to the CPI cap index on the rent. It has 18 years of lease left on it with 4 more options, and each option is 5 years. So that's another 20 years if the tenant wants to extend on that lease. It's in a very prime location. If people are familiar with Frisco, Plano, Allen, McKinney, it's right at that intersection of 121 and Custer, where you have 4 cities meeting together coming up. And then, as you can see on the right-hand side, Sekhar, well, as you can see on the right-hand side, the purchase price, the cap rate is at 7%. The current NOI is 327,000, and that makes the purchase price of 4.6 million. As we mentioned, that's our sweet spot target hit. And then the next property is very, very similar. This was in Fort Worth, and it has food on the border. Everyone local to Texas, California, and in the South might have heard of it and visited it. It's a Mexican cantina food, very well settled. This one has 11 years left on the lease, corporate guarantee, absolute triple net, and this one also has an annual rent increase of 1.5%. Again, 4 options left, 5 years each. And this one was built 99-2000, and it has, and this one we are buying it at 7.35% cap rate, which is very good, very strong cap rate for people. So these are the 2 assets we have currently under contract. Again, same thing. We always like to buy properties that are in a core location, easily re-tenantable, and good location, very strong demographic locations. So Sekhar is going to walk us through the ROI example.
Do you mind sending the link in the chat of the presentation, because a lot of them looks like they're asking.
I did. I resent it again.
Okay. Yeah. So I think some of the questions, as I was quickly skimming through, is around the ROI and the numbers and the depreciation and how all of that work. So first thing is, minimum investment in this is $50,000. And that $50,000, you can do it as an individual, or a few of you, if you are like an early stage employee who just started, you could have 2 or 3 of you combine together, form an LLC, and invest as an LLC. But the minimum is $50,000. So here, what I'm trying to show is, we showed 2 properties, but to be clear, the fund will have at least 5 properties, maybe 6 properties, depending upon the price we get. But each one of the property is going to have something like this. But you, as an investor, you are not investing in one property, you're investing in the fund, which means you are investing in all 5 properties. So if you take an example of one property, for example, let's say you have invested $100,000 in this property. Year 1, you're going to get the rent for this one around $4,000. And for this particular property, the depreciation you're going to get is $47,500, right? What that means is that at the end of the year, you're going to get a K1, which is a tax form from us, which shows that you have a loss of $43,000. It is a paper loss. Just to be clear, the $4,000 you're getting in your hand as a rent, but on paper, we are showing that you have a $43,000 loss, because we are saying that the property has depreciated. What that means is that if you are in a 25% tax bracket, that offsets and you get around $10,000 in tax benefit for you, right? Now, going into year 5, 7, and 9, because this is a fund, we have an option to keep it up to 7 years, plus 2 additional optional years, depending upon how the market. But in year 9, one way or other, we have to exit. We have to, right? So that's why we start looking at it from year 5, saying, hey, is there an opportunity for us to exit and sell this opportunity? So we model all 3 of the years. So let's say, for example, in year 5, we sell this property. By that time, you would have got roughly about $24,000 in rent that you would have already collected from this property. And then you're going to get your $100,000 back. And then from the sale of the property, you're going to get another $34,000. So all in all, from a cash point of view, you're getting roughly about $158,000 in the year 5. Same thing in year 7, it would have been $186,000, and year 9, it would have been $215,000, right? So that translates into ROI of 58% or 87%, 116%, depending upon which year we sell, and corresponding annualized ROIs. Everything on above the light green line is all in cash that you're getting. Below the light green line is the depreciation, which is a paper loss or gain based on which tax brackets you are in. So in this case, if you take the year 5, you had a depreciation of about 74,000, roughly 75,000, with a tax K1 loss of 50,000, generating about 12,000, right? So all of that, what you're seeing in the dark green is if you take advantage of the depreciation against your other gains, right? If you do not take that advantage, let's say you have not taken that depreciation because you have no other benefits or you don't have any other profits from others. There's two options. One is when you sell this property, you reclaim back that depreciation, so you're no worse than that. Or you can continue to take that depreciation loss for 20 years. Any loss from an IRS perspective, you can carry it for 20 years. So in the future, when you have other profits, you can apply against that. And the last but not least is, as we talked about, even when we sell these properties, our idea is that as a fund, we're going to be putting another fund and we're going to be buying more properties in that fund so that we continue to take tax advantage. But there might be, let's say, if 10 of them are part of the fund and they buy and they want to continue with us and they continue to use the 1031 exchange, they will take advantage of that. If one or two of them say that, you know what, I want to end here, I want to exit out of here, in those cases, they will get individually, they will have to take advantage of that, not through the fund. And if they go and buy another property equivalent or higher for their particular share, they will be able to take advantage of that. Again, there's a lot of nuances in there. I'm just covering it high level, but there's options to do that, right? So all the two advantages I talked about from a tax perspective, it is a depreciation, 1031 exchange, and then the last but not least, over a period of time, is the inheritance. This is how you would build your wealth. And in this case, the starting point is 50,000, and you can continue to start building as you grow. So that's, I think, one more. This is for another property. Again, it's the same thing. It's just different numbers. I'm not, in the interest of time, I'm not going to go through that. The last thing I want to share is if you were to invest $50,000, because of the way the fund is structured, it is not that you are going to be asked to give $50,000 on day one. It is as and when we close each and every property, you will be asked to contribute that amount. So in this case, for the first two properties, we have it in contract. The first property is closing end of July. If you sign up, we'll say, okay, at the end of July, we need $10,000 from you for the $50,000 contribution. The second property is closing August 15th. At that point, we'll ask another 10,000. So each and every time, whenever the property is closing, we will send you a request saying that, hey, we need that share of yours for the corresponding $50,000. So that's how the fund is going to work. I know it's a little bit, if it is first time you're hearing, it might be a little overwhelming, but I'll just leave it. This is the process of subscription. If you are interested, you can send an email, and I think Mukesh has also sent a link in the chat where you can just go to the URL and sign up. And let me pause here, and then we can open it up for questions.
Excellent. Thank you, Sekhar. So there are lots of questions here.
Yeah.
I think Madhu is asking, okay, depreciation share is 47K for the first year. How about the year 2 and the year 3 and so on?
Yeah. So in this model, right? So we showed in the year 5. So for example, this is 50,000. Cumulative in year 5 is 80,000, right? So this is only you have invested 100,000. So you're taking 80% of it by year 5. By year 1, you're taking 50%. And by year 5, you're taking 80%. So more likely, if you were to double click between year 1 and 5, it might be like 60%, 70%, 75%, and 80%. And we have all those numbers on in between years as well. But for the simplicity's sake, we're just showing year 1 and year 5 here.
Perfect. Sushma Wadde, she's asking, is there any cap on the number of LPs?
No, there technically, I mean, there's two types of LPs. One is what you call as an accredited investor and a non-accredited investor. An accredited investor is, Mukesh, is it like combined?
Net worth, yeah, the definition changes slightly each year, but it is combined net worth of more than $1 million or a combined family income of more than 300,000 per year. So that can be accredited investments. We have 35 of them allowed. 35 of them can be any investors, and then there are accredited investors that can be any number.
So accredited investors, there's no limit. If you have a combined income of 300,000 or a net worth of 1 million, those are all considered as accredited, and there's no limit on this. If your combined income is less than 300,000, we have a limit of 35. We can only take 35 of them.
So one more question from Srini Rokam. If someone invests in the fund, will they have access to the bank accounts of the properties? I know it's a difficult question to answer, but let's say if I invest 50,000, so will I have access to the bank account?
No, and I gave a very lengthy answer over there. I read it out for everyone's benefit. The entity where you invest the money will be the entity that owns the real estate and has all the equity. The lender has access to the bank account. We generate a quarterly financial report from this bank account and you share it with all the investors, but we cannot give direct access to the bank account to any one specific investor. Our CPA generates the financials and K1 at the end of the year, and CPA has access to the bank account. So that's the long-ended answer for that one that I posted in the group.
Perfect. So
I have a question, additional question on that. So actually the intention is not to have access to the bank, but the reports, whatever reports.
Financial reports are posted quarterly.
Okay.
Yeah.
Quarterly,
Yeah.
and that shared with all the investors.
Yes. Yeah. It is on the portal. So when you log into the portal, you will see the quarterly reports over there in your portal.
So I'm asking these questions based on my experience with two the sponsors, the LPs that has cheated us and I lost 100K doing this investment in Texas.
Yeah, it's very unfortunate, and it's become very common in the last 4 or 5 years when the market was good. It's very unfortunate, and I feel for you. I really, really wish things were tighter, and they were not doing it. But it is what it is. But giving access to bank account is not something that we can do.
It's not possible.
We are not even allowed to do.
Yeah. What happened, right? If I have just 2 minutes, I can explain what happened and how this happens, right? The LP, okay, he's from the same community, our community, right? So he promised us that he showed what are the reports you are showing, everything very conducive, very interesting, very encouraging reports. Okay, we all went into the trap. See, he's a very good person. He has experience, but he didn't invest it. He had the contract, but he had another greedy property contract. He put all this money into that property. He didn't get this contract and he couldn't close it because the interest rates are high, and he couldn't get that other property, and he lost all the money, the escrow money. The 13 million is gone just like that.
So
right?
yeah, I will explain you.
Everything is hidden. What he's doing, the LP, whoever sees.
So let me give a short answer because Venkat wants us to wrap up here and also address all the other questions. I'll give a short answer to all the things that are happening in the market and the way investor. Like I was an investor before I became a sponsor, right? Always see if the sponsor is offering you a fund documents. Okay, it is disclosed to SEC, and you have to do a Reg File D, Form D to file with SEC. That's what we are doing. Many of these syndicators don't even know what that is. They go and raise money and they say, hey, I'm doing this project and everything. They are not supposed to do that. They are not supposed to raise money unless you have a registration with SEC. Okay, so make sure always, everyone on the call, our whole intent is to protect your investment first, right? If you protect, that itself is good. If you can grow it, you don't want to lose your hard-earned money, right? Always ask the sponsor, is there Reg D that was filed? If it is please ask for a form for it. Okay, whether your attorney drafted the documents or not, and make sure when you sign up, you are signing the class PPM. It's called Private Placement Memorandum. That's the only document that you are supposed to sign, along with the operating agreement of the LP entity. Make sure you sign that and you take a look at it. That shows where the manager is telling, he's disclosing all the risks, all the assets he's going to invest, where he's going to invest, how much he's going to invest, what is the risk he's taking, what is he investing, and where he's going to use the funds for. All that has to be disclosed in the PPM. Okay, when the investors don't know about it, they don't ask, and the syndicator gets away with it. Once he has all these things documented and he's giving you the subscription document to subscribe to that share, it is going to SEC, and it is filed over there. So now if he deviates the plan, he's saying, hey, I was going to invest in commercial real estate, whereas he invested in a land, he's a default. You can take him to the court and say, boss, you did not do what you told you are supposed to do, right? So everyone on the call, guys, it is hard to vet a person just by seeing on video. If no one knows me or Sekhar on the phone call, how are you going to vet me, right? You're going to go to my LinkedIn profile and Facebook profile. That's how you're going to vet me. That's not a good way of vetting out sponsors, right? You need to vet the documents. That's the only best way for you to secure your investment, guys. Okay, that's my 2-minute pitch on that. Okay.
Yeah, and just summarize, like, I think apart from all of that, there's 3 points I want to mention. Is that one is that as a sponsors, we're putting in money, right? That's number one. So like I said, that's important because we put in the money. The second thing is for the escrows specifically that you talked about, like for example, in these 2 properties that we have, Mukesh and I put the escrow amounts, right? It's not the investor because we haven't taken any amount money from anyone. So just to give that as a perspective. I know there's a few other questions. I want to make sure that quickly we hit on them. One is in terms of if somebody committed for class A, class B, doesn't matter which class you have, we're going to be calling for that investment, the pro rata share of it, as and when we close on these properties, and you have to send that. It's not an optional for that. Most of these, you will have at least 1 month notice period because the first 2 properties we're already in contract, so we have the dates for them, which is the first amount needs to be there before the end of July, the second one by August 2nd week. The third and fourth and fifth, we don't have them in contract. Anytime we get into a contract, we'll have a more than likely 30-day period to close. And so we'll send all the investors saying, hey, prepare with your pro rata share of it 30 days from now.
Perfect. So we have a bunch of questions, I think very, very important, Sekhar and Mukesh. Number one, what will happen if a tenant files for bankruptcy or eviction or gets evicted?
Good question. There is a reason why we are going after corporate guaranteed leases. That means the tenant location itself is not the only guarantor, it is also the corporate. So let's say the on the border in Fort Worth closes, right? It is guaranteed, it is backed by the corporate guy. So that means the corporate company will still continue to pay us the rent until we find a new tenant. Okay, so that's the additional protection we have over there. And third thing, it's a high credit rated tenant. So what we look at is the credit rating of the tenants also before we buy the property. See, there is nothing you can do if the company does go bad. All you can do is protect yourself. Will the company go bad? What is the probability of a company going bad? And if it does, how are you protected? That's all we can do.
Yeah, and because it's a fund which has 5 different assets, all 5 of them going bankrupt are minimal. And even if one of them goes bankrupt, for example, and we have 2-3 months or 6 months of free time, the rest of the properties are going to be able to still be able to generate income, right? So your income might go down slightly, but it's not like it's going all out. And there's another important question, I think, about the loan. There's an extremely important thing is that as investors, you're only putting the equity. So in this $25 million fund, there's 10 million of equity, including Mukesh and my amounts that will be going in as investors. And then there's a 15 million of loan for across all these properties that will be on my and Mukesh name. It's not on investor's name, right? That's important. And that's the reason part of the GP and the sponsors is that the loan is given based on my tax returns, Mukesh tax returns, and our asset profiles and everything. That's how the bank gives it. So it's not on you as investors, you're not going to have a loan on your name. So hopefully that answers. And
it's a full recourse loan, both on me and Sekhar, not on any investors.
right?
Okay. Next question. Can H1B holders invest in the fund?
No.
And
No.
how can they claim the tax benefit?
No, they cannot. They cannot invest. H1B and E, they cannot invest.
Okay. So H1B cannot invest. Okay.
Yeah.
Second.
So the short answer is that there is a long answer, but I will just give a short answer right now to keep it low, to keep it simple. There are certain
even if they're a
conditions
part of
that
an
they have to
LLC.
meet, Venkat.
And
We can talk
I
about
think
that.
they can open an LLC, right? They can open an LLC, and if the wife is on a H4 EAD, that makes it simple, correct?
I will tell you, there is a technical answer and then there is a risk answer, okay? A legal answer. The technical answer might be what you are giving. The legal answer is if they find out that he is generating any other source of income in the country, it is an immigration question as opposed to us. So that's the reason why on the safe side, I am telling no. Is there a technical way of doing it? And is there a way for you to ask your attorney and do it and claim the K1s and generate that additional income? I'm not the right person to answer that question. Maybe Om, if he's on the call, he might know a little bit more and he can add more shed and shed more light on it. So
Next.
Mukesh, I think you are right, Mukesh. You cannot claim if you're on H1B. I'm 100% sure on that.
Okay. We'll move on to the two more questions. Is this the first time that Mukesh and Sekhar are doing this fund concept?
No, in Dallas, we have completed around 11 projects successfully. Ground up development, acquisition, land flipping, zoning, and acquisition. So we have done quite a bit in DFW area.
And personally, me, I have done funds in the technology space, not in the real estate space. Obviously, Mukesh has done it in the real estate. So that's why we are coming together in this case.
So for small investors who want to do this, who want to replicate the same thing on their own, what is the best way?
The best way is for you to look for, see, the challenge, the reason for we having the fund is there is no easy way to find the same returns at 7% cap rate for a property less than $1 million or less than $2 million. The smaller the property, the low, the higher the price it is based on the cap rate, right? So the competition is high, the cash flow is less, and the lender doesn't have much flexibility because your DSCR ratio is also very tight, right? You cannot increase the rent as much. The reason why we went with this model of fund is to be able to buy bigger assets and as Sekhar rightly mentioned, democratize it so to smaller unit of 50,000. You can't buy a commercial real estate property and participate in a 5 million asset with just putting 50,000. This is the best way for you to participate. If you want to do it individually separate, you have to sign for the loan, you have to find the asset, and you don't have any diversification because now you are putting all your eggs in one basket by putting 500,000 or 1 million in one entity, in one asset as opposed to multiple assets. Does that answer? Good?
Yeah, I think that answers. So sorry, actually, I'm not acknowledging. I'm jumping to the next question for lack of time. Can UK citizens invest in the fund? And
Yes.
I think another question was, can anybody from India participate in the fund?
If they don't have a debt, then yes. If they don't have in this fund, yes. Yeah, the short answer is yes.
So another question is your model investors are not gaining on leverage, right? But no, you are, because you are gaining on the overall value of the property, which includes the debt that is taken, right? So you are all of you are getting. And then I think there was another one about if somebody wants to exit the fund before the end of the fund, unfortunately, you as an investor cannot exit the fund before the fund terminates. The only option is you can sell your share to somebody else. And that's something that we will support, but we won't buy back your share before the end of it.
Right. And to answer the next question on loan, we already addressed. The loan guarantee is completely on only me and Sekhar, the sponsors, not on the investors.
So is there a minimum rate of return per year, regardless of how many tenants occupy the property? Nagashiva Bonala. I think
No,
that's it.
so yeah, so there is no min and max. If there is a tenant, we get paid. If there is no tenant, we don't get paid, right? It is as simple as that, right? There is no, what do you call it, pref in this fund, right? We are not giving pref out. We are just saying whatever the dollar comes in, we are splitting is 85-15. 85% goes to investors, 15% goes to the sponsor. That's it. Yeah. There is no minimum or maximum. As long as the property is generating rent, the 85% of the cash flow will continue to get distributed every quarter.
Next question from Vamsi Possibility. Is the ROI prorated because the installments are actually coming in installments?
No. No. So our plan is to close the fund as soon as we reach the max equity that we are going to raise. So if we are going to raise only equity for 3 properties, we will close the fund after 3 properties. If we are raising the equity for 5 properties, we'll raise the equity for 5 properties. But your cash flow is coming in only when there is an asset that we purchased and only for that asset. So let's say, as Sekhar mentioned, right, property 1 and 2 are in contract. Right, and let's say we close property 1 in first week of August and for third week of August property 2, you will start getting the rent for Q3 for these 2 assets only. In Q4, if we buy another property, you will get the cash flow and you will do the capital call of that property for that quarter Q4. If you don't buy any asset, if you don't find a good asset, then you will not get the cash flow. We will not do a capital call for you guys. So you don't have to put the money. Does that clarify?
Yeah.
Yes,
So,
yes, thank you.
Thank you, guys. So with a small break, I would like to talk about Atmiya. So Atmiya is a community organization just for the community that focuses on education, enrichment, empowerment, and elevation of the community through multiple value-added services. So we conduct the sessions on real estate, stock market, and businesses and career growth, immigration, and women empowerment and youth empowerment. Almost every week, we conduct like 2-3 sessions. So if you are from the community, we highly encourage you to obtain Atmiya membership. The link is posted in the chat, and also Atmiya is conducting a 2-day national conference, and we will be conducting live workshop sessions on all these aspects, especially how to we are about Atmiya is about empowering the community, and it's about how to create wealth for yourself and for your family. And as Sekhar said, yeah, it's going to be generational wealth. So we focus on stock market, focus on real estate, we focus on businesses, entrepreneurship. So if you're not yet a member, become a member. If you haven't registered for the national conference in Labor Day weekend, please register and attend. It is in Dallas. And we look forward to seeing you. So with that, Mukesh, we'll go to the next question. If we invest in class 3 for 50K, then how much will we get monthly as rent and how much we get after 7 years?
Sekhar, you want to take the ROI?
Yeah, I'm going to just, all of this is shown based on 100,000. So think about just divide it by half if you were to do it 50,000. So these are distributions will be on a quarterly basis, and then the income, the distribution of profit is only after we sell. Whether we sell in year 5 or year 7 or year 9 depends upon the market conditions and everything. We just illustrated all these different options. Again, this is for 100,000. So if you do 50,000, I would just divide everything by 2.
Yeah, and just people know if there are 2 people with 50K, they can come in an LLC with 100K. Yeah, so that's another way of upgrading people from class A to B to C. If some people come together into an LLC and instead of going in class C, they might jump into class B and vice versa, also into class A. So
Perfect.
Getting better ROI.
So there are some questions about the recording of the session. Yes, this particular session is getting recorded. In fact, we have close to 600 such sessions on our Atmiya website and the Facebook group. So if you're not yet a member, please join, and you can get access to all these sessions for the past 5-6 years. Thank you. And next question.
Yeah, there was a question about the property getting closed and when will the capital call, etc. So this is the schedule that we are showing here. Essentially, the first property will be not actually July 15th. It will be end of this month, July 30th. So we will be calling for the capital call around the last week of July for the first, if this is based on 50,000. If you were to invest 50,000, we'll be asking you to send 10,190 by end of July. And the next one is closing August 15th, then another 10,000. And when the next property will be closed, we are going to be asking for that. This is all based on 50,000. Depending upon whatever the amount, just multiply by that in multiples of 50.
So one question, I think, we will take 2 more questions. I'll actually repeat one of the questions posted earlier. What's the difference between investing in India and investing in US when it comes to depreciation and tax benefits?
Venkat, before we jump into out of US, there is an important question someone asked, saying, are GP holders are only one benefiting on the leverage? No, it is not. The entire rent and the sale proceeds that are getting into the property is getting distributed to all investors. We are not saying the only is the 1/3 equity you are getting to benefit. No, you are getting the benefit of the entire 100% cash flow, less the 15% that the GP is taking. That's it. Everything else is equally distributed. So I just wanted to make sure that important question was addressed in the group.
Yeah, we already answered that. Thank you, Mukesh.
Okay. Yeah, Sekhar, go ahead.
Yeah, so I mean, see, we're not the expert. I'm not an expert, definitely, on the India depreciation laws and how the tax laws are there in the India side of it. So I'm afraid I won't be able to answer that question, Venkat, in terms of the difference between India and US on the depreciation side of it.
Perfect. And I think someone asked Venkat Jetty, if you want to reach out to the sponsors, the details are shared here. Okay, so I think with that, this is a great opportunity, Sekhar and Mukesh, and Mukesh has been completing, and he has been working on multiple projects, especially in Dallas area. Is very familiar to those investing in real estate. And then Sekhar also has been there for, I believe, 3-4 years in real estate, but in technology for almost 20 years. So both are seasoned entrepreneurs, seasoned and experienced sponsors, whether it is in tech fund or real estate fund. So if this particular fund interests you, yeah, please reach out to them. The details are already shared in the chat. So with that, thank you, Sekhar, and thank you, Mukesh. Real estate is a great way to generate wealth and actually pass on the wealth to the next generation. So thanks for sharing all the information. And I think the fund is a win-win situation for everyone. I think is going to benefit individuals, is going to benefit the community. So this is a great opportunity for everyone to participate. Thank you, Sekhar. Thank you, Mukesh.
Yeah.
Thanks,
So we
Venkat.
want to thank everyone to take your time on a Sunday afternoon to attend this. So appreciate you all. Thank you.
Thank you for facilitating this, Venkat and Om and everyone.
Thanks, Venkat.
Thank you. Take care, everyone.
Yeah. Bye. Bye.
Bye, guys.